All right, from Main Street to Wall Street, we're continuing to track the way that coronavirus is impacting businesses. We've been seeing the banks report all week, and today we got the latest report from Morgan Stanley. And again, the trends continue to fall into place. What we've seen from banks, Morgan Stanley reporting a miss on its top and bottom lines, but one standout still remaining there when you look at the results from its last quarter, trading revenues there beating estimates yet again. And I want to bring on Brian Cheung for more on the way that Morgan Stanley, it sounds like, Brian, kind of falling into the trends that we've seen. Again, misses on top and bottom lines, but still trading one of those areas they can say, look, at least this hasn't fallen completely off a cliff.
Yeah, well, another nasty quarter from the big banks. We had Morgan Stanley reporting this morning, third day of bank earnings and the real start to this first quarter season. They reported revenues on the top line of $9.5 billion. On the bottom line, they delivered net income of $1.6 billion for adjusted earnings per share of about $1. That's 99 cents. On the net income, that was a 32% year over year decline, which sounds pretty terrible, but not as bad when you compare it to Bank of America, Citigroup, Goldman Sachs, all of which reported about 45% year-over-year declines yesterday. So something remarkable for Morgan Stanley, though, was really their performance on the underwriting side of things. Keep in mind, Morgan Stanley and Goldman Sachs really make up the bulk of the investment underwriting banking business on Wall Street. And they actually reported over $70 billion in underwriting for corporate and municipal bonds because of the fact that a lot of these corporations and local municipalities were turning to debt markets to really survive through March. And that meant that the underwriters were getting quite a lot of business. They actually said they saw record levels specifically in investment grade underwriting, those companies that are slightly in danger of falling into junk bond territory. So Morgan Stanley appearing to be the prettiest of the ugly bunch, if you will. You can see that in the shares as well. It's trading down by only about 0.5% when you compare that to some of the more precipitous falls among the other large banks like Wells Fargo, almost down 6%, Citigroup almost 5%. And JP Morgan Chase about 3.5%. So Morgan Stanley not suffering as bad in trading today.
Yeah, not as bad, but you're right. I mean, those other banks did get spanked when they reported, and I guess you could say things not necessarily looking good for some of those. But Morgan Stanley is an interesting one when you think about their recent takeover of E-Trade and the way that that was going to be going through too. And I know that that has an impact on the way that the bank could be operating in the future, and potentially some saying that it could impact the deal itself. But our next guest does not necessarily agree with that take. That is, of course, D.A. Davidson, Managing Director of Equity Research, David Konrad, who joins us now on the phone. And David, when we look at this, you do say that moving forward for Morgan Stanley, that there could be some risks tied to the way that that transaction with E-Trade might weigh on earnings in the future. But you're still pretty confident that that one's going to be a general boost for Morgan Stanley relative to the other banks, right?
Yeah, I certainly believe that the deal will go through. Gorman has wanted to buy E-Trade for the bulk of his career now. I think it adds a lot of liquidity and customer digital consumer capabilities to the Morgan Stanley platform. I think one thing they're really focused on also is really tying in asset management businesses with corporate America. So it's a lot of stock vesting transition into investable funds that they're driving at. So, Morgan Stanley and E-Trade and maybe a closer competitor, Schwab, the stocks have been trading kind of in line with each other. So I don't think any particular one of these stocks has fallen out of bed relative to the market that would potentially halt the deal.
Yeah, and when we talk about all these banks, obviously they have different specialties, different strengths across the board. I know you follow most of them here that we're going to be discussing, but when you look at kind of the impacts and risks to whether or not things continue to get worse moving forward, just the move that we saw from JP Morgan Chase adjusting their mortgage lending requirements, trying to make those a bit more strict since they don't know how long this lasts and how much risk they have in terms of some of those loans defaulting here. What do you think people should be looking at when you try and weigh those risks and how some banks might be well positioned relative to the others?
Yeah, I think uncertainty is the big story coming out of the quarter. I know when you look at some of the broad-based numbers coming out of the banks, they look disappointing. But actually, when you look at core revenues, less expenses, there's been strong beats. It's really been the reserve build, anticipating future losses, which is what has driven down the results. And frankly, part of that is an accounting change that was implemented in the quarter that's created a lot of this volatility. I think when you think, you discussed about the unemployment earlier in your show, I think where banks are uncertain here is the peak of unemployment in the second quarter. Then how quickly do people with the furlough go back to work? When do we reopen the economy? And does the government programs bridge that? But we're anticipating, certainly still double-digit employment even after that, which would create some form of credit losses similar to the last cycle. The difference here, though, is banks' balance sheets are much stronger. They were all able to put up strong reserves and make money. And so we think there's another quarter of big provisions coming. But then I think they've got a lot of that consumer risk ring-fenced in our view. We'll be looking to add more exposure to the names after that.
Hey, David, it's Brian Cheung here. So we were listening to Neil Kashkari. He posted an op-ed earlier this morning saying that he would prefer that the banks raise more capital and actually calling for the banks to suspend their dividends. We heard James Gorman earlier this morning on CNBC saying he doesn't plan on doing that. It seems like the big banks won't be doing that as well. But I guess aside from the question of should banks be suspending their dividends, I guess the larger question is, do the banks have the capital to support the amount of lending that's really needed out there? We know the PPP program's already dried up. Small businesses and households need credit right now. But with the capital levels that banks have right now, can they meet that demand, or will they need to capital raise somewhere?
No, I do not think they need to cut the dividend, nor do they need a capital raise. Banks are still, again, well capitalized. Each of these banks, when you look at Citi, JP Morgan, and Bank of America, grew loans by, $50 to $60 billion in March. They are providing the liquidity to the marketplace. Now, the payment protection program doesn't impact their capital. That's kind of a pass-through through the government. But we are seeing extraordinary lending coming out of the banks and supporting the liquidity needs of their customers. And so even after that, I look at capital levels next quarter, they may drop a little bit. But when you think of the level of reserves that they have to ring fence the assets coupled with the balance sheet increasing and still being well capitalized, I don't see the need for that right now.
And then, David, lastly, the street seems to be favoring those that are more Wall Street facing as opposed to Main Street facing when you look at the reaction to Goldman Sachs and Morgan Stanley earnings, because they seem to do pretty well with their trading desks. But I'm wondering, with market volatility, they did better in March 2020 than they did in the market volatility when everyone was getting slammed on FICC trading in December 2018. What was the difference here?
Yeah, I think what's happened here is a lot of the volatility, especially in rates and currencies, really helped the numbers. The other thing that helped the trading numbers, remember the liquidity really dried up until the Fed created a lot of the commercial paper backup programs on the repo facilities. So there was a lot of activity that the banks lent their balance sheet out in the repo market that really helped this trading activity this quarter. As we ended March, though, I think volatility has eased up. The Fed is providing more liquidity. And also on the hedge fund side, we're seeing a lot of deleveraging. So I think that model gets a little bit tougher in the second quarter than the first quarter.
Yeah, that kind of plays out in the numbers that you have on these banks, too. And you look at Morgan Stanley, 60% below the street for second quarter and 17 below the street for Q3. So we'll see what happens out there. But for now, appreciate you taking the time, David.
Thank you.